Imagine a nation teetering on the edge of economic despair. Growth forecasts slashed, inflation creeping back up like an unwelcome shadow, and productivity grinding to a halt. Welcome to the UK in 2025, where stagflation looms large, the toxic mix of stagnant growth and rising prices that's squeezing households from all sides. The Bank of England, with interest rates stubbornly high among advanced economies, isn't helping. Instead, it's choking off recovery while house prices soar to record highs, locking out the young and fueling wealth inequality. Firms are slashing hiring amid looming minimum wage hikes and tax burdens, industrial output plummets to pre-credit crisis lows, and energy costs remain Europe's highest, hammering what's left of manufacturing. Yet, amid the gloom, glimmers emerge. A robust minimum wage lifting low earners, low unemployment, on paper, at least, and potential for confidence-driven spending if rates ease. But with an aging population straining public finances, regional divides widening, and global trade tensions brewing under Trump, the big question hangs heavy. Where will growth come from? As living standards falter and poverty persists despite any uptick, this isn't just economics. It's the story of a society at a crossroads, begging for bold change before the mess deepens. Story: the UK economy in 2025 paints a picture of persistent struggle, a continuation of the sluggish performance that has defined the past 15 years. Recent announcements from the Bank of England have only amplified the concerns. Growth forecasts downgraded, inflation projections upgraded. It's the epitome of the worst of both worlds, stagflation, where economic expansion stalls while prices rise relentlessly. Adding insult to injury, the bank suggests that productivity growth, already dismal over the last decade and a half, might be even worse than official statistics indicate. This revelation underscores a deep-rooted malaise in the UK's economic fabric. At the heart of this predicament is the Bank of England's monetary policy. Interest rates remain at the highest levels among advanced economies, a stance that coincides with the UK's lowest growth rate in the final quarter of the previous year. This high-rate environment is intended to tame inflation but risks further dampening economic activity. Businesses are feeling the pinch, particularly with upcoming increases in the minimum wage and national insurance taxes. Signs are emerging that firms are pulling back on hiring, opting instead to conserve resources amid rising labor costs. This hesitation could exacerbate unemployment pressures, even if official figures paint a rosier picture. Amid these challenges, one sector defies the downturn: housing. House prices hit a record high in January 2025, buoyed by persistent demand and limited supply. While this might seem like a positive for homeowners, it highlights broader inequalities. The UK has fewer housing units per capita than many European counterparts, driving average prices to 8 times median income, worse in high-demand areas like London and the Southeast. Rents have followed suit, consuming a disproportionate share of household budgets, especially for lower-income families. This housing crunch not only stifles mobility but also contributes to rising wealth inequality, as properties are increasingly snapped up by investors, including foreign ones, rather than first-time buyers relying on income alone. Looking at the bigger picture, real GDP has seen some modest increases over the past 15 years, but per capita figures tell a more sobering tale. Adjusted for population growth, real GDP per capita remains below 2019 levels, barely inching forward. The pressing question is, where will future growth come from? Without it, the government's ambitious plans for tax and spending face severe constraints. Public finances are already stretched, with forecasts from the Office for Budget Responsibility, OBR, warning of ballooning debt in the absence of policy changes. Inflation, once tamed to near the bank's 2% target, is poised for a resurgence. Headline rates have dipped, but core inflation, excluding volatile items like energy, remains elevated. The bank anticipates further upward pressure from gas prices and other costs by year's end. This isn't demand pull inflation from a booming economy or wage surges. It's cost push, driven by external factors like energy hikes. Such inflation erodes living standards, hitting lower-income households hardest, as they allocate a larger portion of their budgets to essentials like heating and food. The timing couldn't be worse for vulnerable groups. including pensioners who've recently lost their winter fuel allowance. The UK's energy market exacerbates these issues. Despite diversification efforts, electricity prices are tied heavily to gas, making the country vulnerable to global fluctuations. UK electricity costs are the highest in Europe, a factor that's accelerated deindustrialization. Industrial production has fallen sharply since 2021, now lower than pre-2008 financial crisis levels. This decline reflects broader structural shifts: a shrinking manufacturing base, compounded by high energy bills that deter investment and competitiveness. Many of these problems stem from long-term decisions or indecision on investment and productivity. Total investment as a share of GDP languishes at just 18%, far below peers, due to subdued private and public sector activity. When investments do occur, they're often inefficient. For instance, building tramways in the UK costs significantly more than in countries like Spain, yielding poorer returns. This inefficiency traps cities and towns in outdated infrastructure, limiting economic potential. The government has outlined plans to boost public investment, targeting around 2.5% of GDP, alongside initiatives like new reservoirs, nuclear power expansions, airport growth, and relaxed planning laws for housing. These steps are welcome, aiming to unclog bottlenecks and spur activity. However, their impact will unfold gradually over years rather than months. Success isn't guaranteed, and even if growth accelerates, it may not translate to widespread prosperity. A report from the Joseph Rowntree Foundation highlights that strong economic expansion often fails to reduce relative poverty after housing costs. Growth can inflate rents and property values without trickling down to the poorest, whose incomes stagnate amid frozen benefits and real wage erosion. For the average household, economic health boils down to affordability of basics, not abstract GDP figures. Housing affordability is central to perceptions of well-being, yet the UK's chronic shortage drives prices ever higher. The rented sector is particularly strained, with scarcity pushing rents up and forcing tenants to sacrifice elsewhere. This dynamic widens the wealth gap, as asset owners benefit while others fall behind, especially the young, for whom homeownership feels increasingly unattainable. There are a few silver linings. The national minimum wage has risen substantially, boosting earnings for low-paid workers in sectors like cleaning and hospitality. This policy has helped narrow income inequality since 2000, providing a buffer against inflation's bite. Unemployment at 4.5% is far below the 10% averages of the 1980s and 1990s. However, this metric may mask realities. Critics argue that stringent benefit rules push people from unemployment to sickness benefits, where sanctions are absent and payments higher. Combining these categories shows a 1 million increase since 2018, suggesting hidden labor market slack. Businesses, meanwhile, grapple with mounting pressures. Sharp minimum wage jumps, national insurance hikes, and lingering high energy costs. These factors deter hiring and investment, perpetuating a cycle of caution. Globally, trade tensions add uncertainty. President Trump's tariff threats could spare the UK somewhat, given his nods to closer ties, but his policies are erratic. Rising protectionism will likely hurt export-reliant economies like the UK's, especially post-Brexit. While service exports, particularly financial, have thrived since 2016, goods exports have suffered from new barriers, reinforcing the economy's tilt toward services and London-centric growth. This regional imbalance is stark. London dominates investment, jobs, and wealth, creating a two-speed economy. Outside the capital, 42% of graduates can't secure graduate-level roles, forcing many to relocate to London amid sky-high rents averaging over £2,000 monthly. Removing London's figures from national averages reveals UK incomes lagging internationally, underscoring profound inequality. Government budgets operate on razor-thin margins, banking on growth rebounds that may not materialize. If the bank's pessimistic forecasts hold, austerity could return. Higher taxes, spending cuts, or increased borrowing that rattles markets. Longer-term, demographics pose a ticking bomb. Despite migration, an aging population means more pension and healthcare demands, fewer workers paying taxes. The OBR projects public debt surging without reforms. Taxes are already at record highs as a share of GDP, leaving little room for hikes without backlash. Scandinavian models with elevated taxes work because they deliver efficient public services. In the UK, years of austerity have left waiting lists ballooning, potholes unfilled, and local councils on bankruptcy's brink. Social care strains intensify, prompting council tax rises up to 25%, another burden on households. Is this pessimism overstated? Possibly. Economies can surprise with resilience, and pent-up savings from low confidence could fuel spending if stability returns. The bank might cut rates, igniting investment. Sterling, despite recent dips, is 10% above 2016 lows, reflecting relative strength from high rates. Historically, the UK has endured worse. 1980s unemployment over 3 million, 1990s recessions with 15% interest rates and house crashes, 1970s strikes and IMF bailouts. The 1960s golden age had lower living standards. Since 1957, real GDP per capita has tripled, affording more goods and services today. Yet, invoking past hardships won't console voters. There's a palpable sense of relative decline, the UK lagging peers amid shared global woes. The regional divide exemplifies this. London's prosperity contrasts with the rest's stagnation, a disparity uncommon elsewhere. Addressing it requires targeted investment beyond current plans. Ultimately, the UK needs growth catalysts, productivity boosts, infrastructure overhauls, energy reforms to avert Messier outcomes. Without them, living standards will suffer, inequality widen, and public services crumble. The path forward demands vision, not just hope, to break the cycle of underperformance.